Hey everyone, welcome to The Explainer. Today we're looking at a massive, glaring paradox that's sitting right there in the Asian market data, literally hiding in plain sight. We had two giant pools of capital looking at the exact same global setup, right? And they made completely opposite, highly aggressive moves. So we're going to decode exactly why that happened and how it completely manipulated the headlines you're seeing today. Let's get right into it. Let's start with the big, flashy headline number, 8,864.24. The KSPI index surged by 1.58% today, closing at a staggering all-time record high. Now, on paper, you look at that and think, wow, unstoppable bullish momentum, right? But as we know, a single headline pretty much never tells the whole story. Okay, so let's dig into this central mystery. If we put on our detective hats for a second, we have to ask ourselves, wait, how exactly did the overall market hit a record high when the two biggest players in the room moved in totally opposite directions? On one hand, we saw incredibly aggressive, heavy buying from domestic institutions, but that completely clashed with massive, sustained selling from foreign investors. So who was right? Let's look at the evidence. Well, here's where the illusion totally breaks down. On the exact same day the index reached its highest peak in history, the vast majority of individual stocks actually lost money. Crazy, right? Only 349 stocks advanced, while a whopping 526 declined. So the broader market itself wasn't actually rising. The headline index was literally just being pulled up by invisible strings. To understand those strings, we have to look at the market open. Following a pretty rough decline in the US markets the session before, the Korean market obviously opened weak. But here's the thing, domestic institutions didn't panic at all. In fact, they immediately treated this early weakness as a massive buying opportunity. They looked right past the initial shock because they saw it not as some fundamental systemic failure, but just a mechanical glitch offering a huge discount. So what exactly was that mechanical shock? All right, here is our first major clue. On June 16th, SpaceX options actually started trading. And to buy into those shares, these massive passive funds that track the Nasdaq 100 urgently needed capital to balance out their portfolios and cover those new positions. To get that cash fast, they were essentially forced to rapidly sell off their existing holdings, which then triggered a really sudden 5.71% plunge in the Semiconductor sector index, or the SOX. And the data totally backs this up. It proves this US tech sell-off wasn't some widespread panic. The selling was hyper-concentrated on just 9 specific semiconductor companies. Why them? Because they're dual-listed, meaning they overlap in both the Nasdaq 100 and the Semiconductor index. Meanwhile, if you look at the pure Nasdaq 100 giants outside of semis, Google, Apple, Meta, they actually went up. So this was absolutely a mechanical liquidity drain, not a fundamental crisis. And guess what? Domestic institutions clearly understood that exact mechanical dynamic. They knew the global semiconductor fundamentals were perfectly fine, so they aggressively pivoted to the local market champion, SK Hynix. They bought in heavy, completely brushing off that artificial global tech shock from the night before. Honestly, the sheer scale of their conviction here is just staggering. Take a look at this. Over a quarter, 27.2% to be precise, of the trading volume for the entire KOSPI index flowed into this single stock. Just one stock. That means hundreds of other companies were literally just left fighting over the crumbs. So why all the love for SK Hynix specifically? Well, beyond just ignoring the US sell-off, there were some massive structural catalysts at play here. First up, the market is expecting SEC approval for their US listing and ADR, which would suddenly unlock billions in American capital. Combine that with record earnings fueled by the whole AI memory boom, and boom, these catalysts drove the stock up almost 6% to its own all-time high. Now, let's zoom out for a second and look at the macro safety net that kind of give them the confidence for this bold domestic buying. A US-Iran 60-day Memorandum of Understanding was agreed upon on June 14th, with a formal signing scheduled for the 19th. This bit of geopolitical relief actually sent WTI crude oil dropping down to $74.66 a barrel. And naturally, falling energy prices give everyone this underlying expectation of inflation relief, which creates a really nice supportive backdrop for a broader equity rally. But wait, remember that massive foreign selling we talked about earlier? Let's shift our investigation over to them. See, foreign investors weren't looking at SK Hynix at all. They were entirely focused on playing defense against hawkish central banks that are trying to keep interest rates high. Over in the US, the upcoming Federal Reserve meeting carried a 60% probability of at least one rate hike. And at the exact same time, the Bank of Korea confirmed their own 2% inflation target would be exceeded all the way out through 2027. These dual macro reports triggered exactly what's known as flattening the yield curve. To put that in plain English, short-term interest rates spiked because people were immediately terrified of a rate hike, while long-term rates actually fell because investors expect that same inflation to eventually drag the overall economy down later on. And this exact squeeze is what caused foreign capital to instantly shift gears. But check out this fascinating hidden signal in the data. Foreigners weren't just blindly dumping their Korean portfolios in a panic. No, they were highly surgical about it. Out of the roughly 999.3 billion won in total equity sold, a staggering 670.3 billion won was pulled straight out of Samsung Electronics alone. So you gotta wonder, why target Samsung? Well, simply put, it serves as the ultimate liquidity source. 67% of the total foreign selling landed on Samsung purely because it is the most liquid asset in the entire market when you need to raise capital quickly. They needed cash fast, and Samsung was basically the easiest ATM to use. So here is the absolutely crucial point to take away from all this. Foreign capital didn't actually flee the country. Instead, they just rotated defensively right into domestic bonds ahead of that Fed rate decision. So while they drained about 1 trillion won from equities, they turned right around and aggressively bought 1,969 three-year bond contracts and 2,298 10-year bond contracts. They didn't leave the casino, they just moved their chips to a safer table. And just to prove they weren't entirely terrified of the market, they were still hunting for specific opportunities. Because even while they were in a net selling posture overall, foreign investors dynamically allocated hundreds of billions of won to specific defense catalysts. For instance, they were buying up Hanwha Ocean, riding high on some major Korea-Canada defense expectations. All right, bringing it all together, the market's true colors are finally revealed here. If you look beneath the headline, this giant sea of red totally masks the few bright green giants that are actually holding up the market. It perfectly illustrates that the KOSPI's record high today was frankly an illusion. It was hiding a broad and pretty painful decline for your everyday mid and small cap stocks. So to summarize this incredibly complex dance of capital we've been tracking, that headline index number, it wasn't a sign of universal economic health, not even close. It was essentially an artificial ceiling, propped up entirely by highly concentrated institutional conviction in a single stock, while the floor was basically giving out for everyone else. Which leaves us with a pretty critical question to ponder right now. What does this incredibly narrow market breadth mean for tomorrow's opening bell? I mean, when a market relies this heavily on just a handful of players and a single stock to hold up the sky, sustainability becomes the ultimate wild card. If you would like to receive news on the closing of Asian stock markets before the New York stock market opens, please subscribe.